What is going on, everyone, and welcome back to the channel. Today, I am bringing you something I have never done before in this level of detail, a full macro fundamental breakdown of every single major Forex currency pair and gold. We are going to cover the Currency Strength Index, the COT report from the CFTC, historical seasonality data, all 8 central bank interest rates, and then an individual pair-by-pair breakdown. By the end of this video, you will have a complete institutional-level macro picture of where every major currency stands right now in May 2026. So grab a notebook because this is a long one. Let us get into it. Part 1. The global macro environment. Before we look at a single currency pair, you need to understand the one theme that is dominating every single market right now, and that is the US-Iran war and the energy shock it has created. Back in late February of this year, US and Israeli forces struck Iran. Since that moment, Brent crude oil has surged over 55%, from around $72 per barrel all the way to nearly $126 at the April peak. It has since pulled back to around $103, but that is still an enormous premium baked into global energy prices. And that energy shock has done one very important thing. It has re-accelerated US inflation at exactly the wrong time. In March 2026, US inflation jumped to 3.3% year over year, the highest level since May 2024, up sharply from 2.4% in both January and February. The monthly increase was 0.9%, the largest single-month jump since June 2022, driven almost entirely by a 21.2% surge in gasoline prices. Trading economics. And today, right now, we have April CPI dropping. The consensus forecast is for headline CPI to rise 0.59% month-on-month and 3.7% year-on-year. Core CPI, which strips out food and energy, is expected at 0.30% monthly and 2.7% annually. Morningstar. What does this mean for everything else? It means the Federal Reserve is stuck. They cannot cut rates. The CME FedWatch tool shows essentially zero probability of a rate cut in the near term, and only around 30% probability of even one cut by December 2026. Bank of America has pushed its forecast for the first Fed cut all the way to the second half of 2027. GBI, direct trading key. That is your macro foundation. A locked Fed, a strong dollar by default, elevated real yields, and every other central bank doing something very different. Now let us break it all down. Part 2. Currency Strength Index I use aggregates 4 things: the interest rate differential between central banks, the COT net speculative positioning from the CFTC, recent economic data surprises, and price momentum. It gives a composite score out of 100 for each currency. Here is where every major currency stands right now in May 2026. Number 1, the US dollar, scoring 72 out of 100. This is the strongest currency on a fundamental basis right now. The Fed rate at 3.625% is the highest in the G8. Inflation is keeping any rate cuts completely off the table, and the dollar is benefiting from safe haven flows related to the Iran conflict. Number 2, the euro, at 68 out of 100. The ECB has been cutting, but has now paused, keeping the rate at 2.65%. The Eurozone is showing resilience, and EURUSD is trading near 1.12, supported by a narrowing rate differential with the US. Number 3, the British pound at 58. The Bank of England is at 3.75%, the second highest rate in the G8, providing strong carry support for sterling. Number 4, the Swiss franc at 55. 0% policy rate from the SNB, but massive safe haven demand from the Iran war is artificially boosting the CHF. Number 5, the Australian dollar at 52. The RBA has actually been hiking. They have raised rates twice in 2026 to 4.10%. This is extraordinary and AUD supportive, but May seasonality is fighting against it. Number 6, 7, 8. The Japanese yen at 44, the Canadian dollar at 42, and the New Zealand dollar at 38. These are the 3 weakest currencies on a fundamental basis right now. Part 3. COT report. What is smart money doing? The Commitments of Traders report, published every Friday by the CFTC, shows exactly how large institutional speculators are positioned in currency futures. These are hedge funds, commodity trading advisors, and managed money, the big players. And this is arguably the most valuable free data the government publishes for traders. Here is the breakdown from the week of May 6, 2026. Euro. Net long 62,000 contracts. Institutions are bullish euro, and they added 7,000 contracts week on week. British pound. Net long 28,000 contracts. Bullish but reducing. They cut 4,000 contracts this week, a mild warning sign. Japanese yen. Net short 38,000 contracts. Institutions are still bearish JPY. They are betting on USDJPY going higher, but they covered 4,000 short contracts this week. The extreme short JPY trade is slowly unwinding. Australian dollar. Net long 19,000 contracts and building. They added 7,000 this week. Institutions are starting to buy the RBA hike story. Canadian dollar. Net short 22,000 contracts and increasing. Bearish CAD. Institutions are adding to short CAD positions. Swiss franc. Net long 14,000 contracts. Safe haven positioning. Money is flowing into CHF for protection from the Iran war risk. New Zealand dollar. Net short 8,000 contracts. Mildly bearish NZD positioning. And now the most important one. Gold. Net long 185,000 contracts. That sounds bullish, but here is the key detail. 6 weeks ago, it was 210,000 contracts. Institutions have been consistently selling down their gold longs. That is 25,000 contracts of gold exposure being removed by smart money. Combined with $12.7 billion of ETF outflows in March alone, the largest monthly outflow in at least 5 years, this is a significant bearish signal for gold at these levels. Part 4. Seasonality data. Now, let us talk about seasonality. I have pulled 50-plus years of historical monthly average returns for every major pair, going back to when the Bretton Woods system ended in 1971, which is when the modern floating exchange rate system began. May 2026 is one of the most consistently bearish months for dollar pairs across the board. EURUSD in May has historically averaged negative 0.6%. That makes May the second worst month of the entire year for the world's most traded currency pair. GBP USD in May averages negative 0.4%, also historically weak. AUD USD in May averages negative 0.5%, historically the second worst month for the Aussie. USDJPY in May is essentially flat, positive 0.01% on average, no directional seasonal bias. USD CAD in May averages positive 0.04%, also basically flat. Oil price is the dominant driver. NZD USD in May averages negative 0.3%, follows a similar pattern to AUD. Gold in May averages negative 0.3%. Post Q1 profit-taking and rising real yields tend to weigh on gold through May. The one thing I want to be very clear about, seasonality is a statistical tendency, not a guarantee. It is one input into your analysis, not the whole picture. But when seasonality aligns with the fundamental and technical picture, it adds confirmation. Part 5. G8 Central Bank Interest Rates. Let me give you the full rate table right now so you have it locked in. The Reserve Bank of Australia is the most hawkish central bank in the G8 right now, sitting at 4.10% after hiking twice in 2026. That is a big deal for AUD. The Bank of England is at 3.75%, holding steady in an 8-to-1 vote. The Federal Reserve is at 3.50 to 3.75%, effectively 3.625%, and on hold with no cuts expected this year. The Bank of Canada is at 2.75%. The European Central Bank is at 2.65%, having paused its cutting cycle. The Reserve Bank of New Zealand is at 2.25%, the lowest of the commodity currency central banks. The RBNZ projected inflation peaking at 4.2% in Q2, and the next move is widely expected to be a rate hike. Cambridge currencies. The Bank of Japan is at 0.75%. The BOJ held in a 6-to-3 split vote, with 3 members voting for an immediate hike to 1.00%. Cambridge currencies. The Swiss National Bank is at 0%. Part 6. individual pair breakdown. Now, let us go through every pair one by one. EURUSD, bullish medium term. EURUSD is trading near 1.1185. The fundamental picture is bullish for euro. The rate differential between the Fed and the ECB is closing. The Fed is stuck at 3.625%, while the ECB paused at 2.65%. As that gap narrows, EURUSD should trend higher. Large speculators are net long 62,000 euro contracts. However, today's hot CPI data could give the dollar a short-term boost and push EURUSD down to test support around 1.1050 to 1.1100 before the medium-term bullish move resumes. May seasonality is bearish, so the short-term move may be lower before the trend continues up. Key support to watch, 1.1050. Key resistance, 1.1400. GBP USD, neutral. Cable is trading around 1.3250 to 1.3488 after a nearly 3% rally in April. The Bank of England, at 3.75%, is the second highest rate in the G8, which provides strong carry support for sterling. However, UK growth is fragile. Services inflation is sticky at 3.5%, creating stagflationary pressure. And COT shows large specs are reducing their GBP longs, down 4,000 contracts on the week. May seasonality is negative 0.4% historically. My view on GBP USD is neutral. It is likely to consolidate in the 1.3150 to 1.3488 range through May before the next directional move. USDJPY, bullish. USDJPY sits between 153 and 157, driven by the widest interest rate differential in the entire G8. The Fed is at 3.625% and the BOJ is at 0.75%. That is a 2.875% carry advantage for USD. That gap is keeping USDJPY elevated. However, the Bank of Japan is under enormous political and market pressure to normalize policy. 3 of the 9 board members voted for an immediate hike in April. When the BOJ does eventually hike, that will be a significant JPY supportive event. For now, USD-JPY bias is bullish, but with a constant tail risk of a BOJ surprise or intervention. Support at 151. Resistance at 158. AUD-USD, bearish, May. AUD-USD is near 4-year highs around 0.7200. The RBA has been the most aggressive hiker in the G8 in 2026, raising rates to 4.10%. That is fundamentally AUD supportive. But May seasonality is the second worst month for AUD-USD historically, minus 0.5% average. And China demand uncertainty and the Iran war risk-off environment weigh on commodity currencies. The 0.7200 level is the critical support line. A break below that turns the technical picture bearish and could target 0.7050 to 0.000. NZD-USD, bearish. NZD-USD is the weakest of the commodity currencies fundamentally. The RBNZ rate at 2.25% is 1.375% below the Fed, and while a hike is coming, it has not happened yet. Business confidence in New Zealand is at a 30-year high, which is a positive forward indicator, but in the current risk-off USD strong environment, NZD is the pair most likely to underperform. COT shows 8,000 net short contracts. May seasonality is minus 0.3%. Bias? Bearish for now, but watch for the RBNZ hike announcement as a potential reversal catalyst. USD CAD, bullish. This is one of the most interesting pairs right now because oil is pulling it in 2 directions. Oil above $100 is theoretically CAD positive because Canada is a major energy exporter. But the Bank of Canada at 2.75% is 0.875% below the Fed, and large speculators are net short CAD by 22,000 contracts and adding. That short CAD positioning is dollar bullish. May seasonality is essentially flat at positive 0.04%. My bias is USD CAD higher, bullish, but oil price is the wild card. If oil pulls back significantly, that would accelerate CAD weakness and boost USD CAD. USDJPY, bearish, CHF firm. On paper, USDJPY should be higher. The Fed is at 3.625% and the SNB is at 0. That is the biggest rate differential in the entire G8 at 3.625 percentage points. Yet USDJPY is being suppressed by enormous safe haven flows into the franc because of the Iran war. Large speculators are net long 14,000 CHF contracts. They are buying CHF for protection. My bias here is bearish for USDJPY. The CHF remains firm, but watch for any ceasefire or diplomatic progress in the Middle East. If the Iran situation de-escalates, CHF safe haven longs would unwind rapidly, and USDJPY would spike higher. Part 7. Gold. Full macro breakdown. Let me spend extra time on gold, because this is where everything converges. Gold is currently at approximately $4,703 per ounce, and despite being at historically high prices, the macro picture is turning against gold in the short to medium term. Here is every factor. Bearish factors for gold right now. The Federal Reserve has no rate cuts scheduled for 2026. Rate cuts are the primary bullish catalyst for gold because they reduce the opportunity cost of holding a non-yielding asset. No cuts means no catalyst. The 10-year TIPS real yield, the inflation-adjusted government bond yield, is sitting at approximately positive 1.94%. That is a meaningful opportunity cost for holding gold. When that yield rises, gold suffers. COT positioning. Large speculators have reduced their net gold longs from 210,000 contracts to 185,000 over 6 weeks. Smart money is selling. ETF outflows. Over $12.7 billion left gold ETFs in March 2026 alone, the largest monthly outflow in 5 years. Institutional investors are rotating out of gold when rate cuts are priced out. May seasonality for gold is historically negative 0.3%. And on the chart, gold has rejected from the weekly bearish rejection zone at 4,750 to 4,770. Bullish factors for gold, which provide support. The Iran war is ongoing, and geopolitical uncertainty provides safe haven floor demand. Central bank buying reached a record 1,230 tons in Q1 2026, mostly emerging market central banks diversifying away from USD reserves. This provides a structural long-term floor, but does not prevent short-term pullbacks. My overall gold view, bearish short to medium term. The key downside path is first target the liquidity pool at 4650, which is where sell stops are sitting below recent consolidation lows. Second target is the 0.618 Fibonacci retracement at approximately 4600, and the full downside target, which aligns with the lower demand zone, is 4560. Conclusion. Let me give you the master summary for every market right now in May 2026. EURUSD, bullish medium term. Short-term CPI risk could dip to 1.1050 support first. GBP USD, neutral, ranging between 1.3150 and 1.3488 through May. USDJPY, bullish. Wide rate gap keeps it elevated. BOJ hike risk is the main threat. AUD USD, bearish for May. Seasonal weakness. 0.7200 is the critical support. NZD USD, bearish. Rate deficit and risk-off dominant. Watch for RBNZ hike signal. USD CAD, bullish. Rate gap and short CAD positioning. Oil is the wild card. USD CHF, bearish USD CHF. CHF safe haven flows firm. Watch for ceasefire risk. Gold, bearish. Declining COT longs. Record ETF outflows. No Fed cuts. Targets 4650, then 4600, then 4560. That is the full macro picture for May 2026. Everything is backed by the fundamentals, the COT data, the seasonality, and the interest rate dynamics across all 8 major central banks. I have put together a full PDF report with all the charts: currency strength index, COT report, seasonality heat map, central bank rate comparison, individual pair scorecards, and the full gold macro analysis. The link to download it is in the description. If this kind of deep fundamental analysis is what you want to see more of on this channel, drop a like and subscribe. Leave me a comment with which currency pair you want me to dive into on the next video. And as always, this is not financial advice. Manage your risk, and I will see you in the next one.